So, another one of the main benefits of the leveraged index arbitrage platform is that it allows a client to experience tax free income drawdowns for retirement purposes. And just to show you an example of how much of a benefit the tax free nature of these income drawdowns are, I'm going to show you an example here, and we're going to use the assumption of a $650,000 household income. We're going to assume that this is a married couple filing their taxes jointly, and we're going to assume that they live in the state of California. So, when it comes to speculating the tax burden on investment gains, there are two different ways to make this calculation. Now, oftentimes you'll hear a lot of CPAs talk about the graduated tax brackets, which means that even if a household is making an income of $650,000 per year, they don't pay the top tier tax bracket on the entire earned income. They pay a lower percentage of taxes on the first X amount of dollars of earned income, and then a higher tax bracket on the next bracket of income, and then another higher tax bracket on the next bracket of income, and so on, all the way until they hit their top tier tax bracket. However, the way I look at the tax burden on investment gains and the tax burden on investment income is that for a household that's already earning $650,000 in earned income, as an example, they've already burned through all of those layers of tax brackets. And so any gains that they earn on top of their adjusted gross income under this perspective would be taxed at whatever the highest income tax bracket they are at based on their adjusted gross income. So based on that tax burden philosophy, someone living in the state of California would pay 12.23% in California state tax on those investment gains. They'd pay 37% in federal short-term capital gains tax. They would pay 20% in federal long-term capital gains tax. And they would pay 3.8% in federal Medicare tax. So under this tax burden perspective, let's take a look at how each one of those assets we previously looked at would be treated when it comes to tax burden. In a traditional investment that was funded with post-tax dollars, they would be taxed at short-term capital gains tax in the amount of 53.1%. And again, that would be applied to their realized gains. When it comes to stocks and real estate, when they do liquidate and or sell those assets, they would be subject to long-term capital gains tax. And under the assumption that they have a $650,000 household income, they're filing their taxes married jointly, and they live in the state of California, they would be subject to 36.03% in long-term capital gains tax. In their qualified retirement plans, whether they be an IRA or a 401k, again, these were funded with pre-tax contributions. When they do liquidate and they draw a retirement income from either an IRA or a 401k, they would be subject to short-term capital gains tax or ordinary income tax, which is basically the same thing, in the amount of 53.1%. Again, this is under the assumption that this household has already burned through all their graduated tax brackets because they're still earning an income of $650,000 per year. Now, the last two assets that we talked about before, the Roth IRA and the life insurance policy, not only are they not subject to a tax burden on any realized gains, they are also not subject to any tax burden when it comes to liquidate. In other words, when the client draws retirement income from either of these assets, they do not pay any taxes on that retirement income that they draw down from either of these assets. Now, the challenge with the Roth IRA is that someone that is making $650,000 in household income does not qualify for a Roth IRA, so they would not be able to contribute anything to a Roth IRA, which would really make the cash value life insurance policy the only asset they can contribute to, wherein they are not subject to long-term or short-term capital gains tax, and they are not subject to any ordinary income tax when they draw retirement income down from the policy value. Now, on the leveraged index arbitrage platform, the underlying asset we use is an indexed universal life insurance policy. And really, that asset can be used for multiple purposes. One, it is a life insurance policy, so there is a life insurance death benefit that can be used to replace the client's income that they would have earned if they were to live a nice, long, healthy life. In the unfortunate event, if the client were to perish early, whether that be a heart attack, a stroke, a car accident, cancer, something where they ended their life much earlier than expected, the life insurance policy would pay out the tax-free death benefit. But what a lot of wealthy clients do is they use the life insurance policy not only for the life insurance death benefit, They look at the life insurance policy as an additional alternative asset that's part of their overall financial portfolio. And one of the reasons they do that is that the life insurance policy adds another layer of protection over their overall portfolio by introducing a risk mitigation feature. And I'll explain what that means in the next video.